Welcome back into the second part of The Big Picture, where we are examining the year 2009 in review. And as we went into the break, we said we were going to look at mark-to-market accounting and the effects that it has had upon everything that is happening here. Also, we'll look at quantitative easing. To do all of this, we need to go back to yesteryear, to late February, probably early March, somewhere in that area. The stock market was down over 25%, and let's face it, things looked pretty gloomy at the time. They seemed to be falling apart. One of the biggest focuses, or foci here, was the fact that banks and other financial institutions were reporting $700 billion in book write-downs, not actual losses. But each quarter, the banks were writing down these huge losses. Then they had to go out and raise capital. And what a lot of people don't realize, Jim, is the destructiveness that mark-to-market forces behind the Great Depression in the 1930s caused, so much so that FDR, Franklin Delano Roosevelt, suspended mark-to-market accounting in 1938. So let's start out with a quick explanation for people who need to come up to speed here on this, and then discuss why it is so destructive in the environment in which we found ourselves in the early part of the year.
There's a couple arguments behind this, but let's talk about what it is. And the easiest way to think of this is, let's say that you went out and bought a package of mortgage securities for $100,000. And because of, the risk factors and because people were selling them, let's say the value of those mortgage securities dropped to $75,000 in the quarter. Well, in one quarter, the market value of those securities dropped by $25,000. And so under mark-to-market accounting rules, you would have to take that market loss of $25,000 and report it as a loss on your income statement. And that was one of the reasons why a lot of these firms, as this deleveraging process occurred in 2008, and there were actual losses too. Don't forget, people were defaulting on these mortgages, especially the junk mortgages that we saw that became so prevalent in the lending frenzy between 2005 and 2007. So every single quarter, a bank would have to take the assets that it held in its portfolio, and if the market value of those assets dropped, they would have to take the loss or the drop in market value and report it as a loss. The problem with these huge write-downs, and this is how it impacted the stock market, is that financials at their peak in 2008 represented 22% of the weighting within the S&P 500. So that when banks were forced to write down their market losses, it literally cratered earnings in the S&P 500. So there were a series of key dates in March that really marked the turnaround in the stock market. On March 10th, Bernanke gave a speech to the Council on Foreign Relations suggesting that the Federal Reserve was open to modification of mark-to-market accounting. On March 16th, the Financial Accounting Standards Board proposed more leeway in mark-to-market accounting, and then finally, on April 9th, the Financial Accounting Standards Board issued an official update. They eased the mark-to-market rules, and they also said at the same time that companies that were reporting their Q1 earnings would be able to use these more lenient measures, and that really began to remove some of the cloud over the markets. Because the market was in a downward track, everybody knew that the value of all financial assets was falling, which meant there would be more losses that these financial institutions would have to report. So basically, in March, we began to reverse mark-to-market, and that set the stage for an earnings improvement. At the same time that the FASB was considering that, Congress announced that if the Financial Accounting Standard Board wouldn't do it, Congress would mandate it through legislation. So basically, we moved to more leeway with mark-to-market, and so that was a key event setting the stage for earnings revival. A second event happened in March, and that was on March 19th, 2009. The Fed announced a massive campaign to stabilize the U.S. economy by saying it would flood the financial system with an additional $1.2 trillion. The Fed announced it would balloon its balance sheet by 50%. And remember, John, the Fed's balance sheet at that time had ballooned to nearly $2 trillion, so they would balloon their balance sheet to close to $3 trillion. In that March 19th statement, the Fed said it was going to buy $300 billion of long-term Treasury bonds. They also said they were going to increase their purchase of mortgage-backed securities by an additional $750 billion, which was on top of the previous announcement of purchasing $500 billion. So if you add it up, the Fed was going to buy $1.25 trillion of mortgage-backed securities. It also said it was going to double its purchase of Fannie and Freddie securities by $200 billion. So what began in September of 2008, when the Fed's balance sheet was at $894 billion at the beginning of September, it rose to $1.9 trillion by March of this year. And the Fed basically said, we're going to increase that by 50%, taking it up to nearly $3 trillion. And from that point forward, John, it was really a green light for the markets to speculate. The Financial Accounting Standards Board had removed the threat of financial write-downs by loosening up mark-to-market, and then the Fed said it was basically going to goose and it was going to print money. So stocks went from being down 25 and 26% to being up nearly 22% on this Friday as we speak. Let me see, what are the S&P 500 numbers? The S&P is up nearly 21.5%. When before they announced this change to mark-to-market and quantitative easing, the S&P 500 was actually down about 26%. So big turnaround. It was basically a green light given to financial participants to speculate. The central bank was going to print and debase the currency, and if we take a look at after that announcement, the dollar, which was at close to 90 at that time, fell to a low of 74.
Well, as we carry all of this forward into next year, there really are two views of what could possibly happen. Number one would be the Fed remains, what do we call it, loosey-goosey, because the economy is in terrible shape. And number two, the other one is that the Fed's probably going to have to start raising interest rates sometime about mid-year. Let's pick up a couple of Bloomberg clips which reflect a lot of this thinking going on.
Yes, we have seen some better data on the manufacturing side with regard to production and employment, but on the non-manufacturing side, which is, of course, much larger, the unemployment situation has continued to worsen for 18 straight months, according to the ISM. So I'm a little surprised that unemployment discussion suggested an upturn, which is what I don't see.
Was this a question of a Fed just trying to get into next year? It's December. Is this just a Fed trying to get to that later January meeting?
I think to some extent that's right. The amount of elaboration in the statements the last several meetings has been toned down. And remember those op-eds in the Wall Street Journal? Very fiery sort of anti-inflation stuff in August and September.
So that Bloomberg discussion reflects point number one, the fact the Fed is going to remain loosey-goosey. The economy is in terrible shape. But number two, the second idea is that maybe the Fed's going to have to start raising interest rates again to keep things from getting out of hand.
How long can the Fed stay on hold on interest rates? Is there a danger that the Fed might wait too long to make a move?
For me, I feel inflation doesn't get created overnight. The inflation that went to double digits in the early 80s, that was something that was a decade in the making. There were many policy errors made back then. They're not going to make the same errors right now. I don't think there's any danger that inflation is going to get out of control. But I would say that once the labor market shows that it's stabilized, unemployment rate is on a downward track, and we get a big monthly jump in payroll jobs, 250, 300,000 new jobs created, the Fed's going to start tightening shortly thereafter. So my view is that they could go as early as the June meeting next year and tighten rates.
So do you have any inflation concerns for next year, or is growth going to be strong enough to keep inflation at bay?
Well, I'm not really that worried about inflation. A lot of times a little inflation is necessary, perhaps, to grease the wheels of economic growth, if you will. I'm